Hello and welcome. Today we are going to talk about the effects of inflation in an economy. Effects of inflation in an economy. What is the impact? What is the effect of inflation in an economy? And we have noted that in our previous lesson that changes in relative prices occur during periods of inflation, since all prices and wages do not move at the same time. Okay? The relative prices occur during periods of inflation, since all prices and wages do not move at the same time. And because of changes in relative prices, inflation has some major effects in the economy. So, and the reason why people get concerned about inflation is that its effect on the distribution of income is because of its effect on the distribution of income among the population. And a general view about inflation is that it affects the lower and middle income groups more than the upper income groups. And sometimes this is expressed loosely through the phrase you have heard that the rich are getting richer and the poor are getting poor. It is due to the fact that inflation hits those who are poor harder than those who are rich, because the amount of inflation, it affects the poorer more, because the poor are now forced to spend more on buying prices of commodities because of inflation. So the effect of inflation may be felt more by the lower income group because it has a greater effect on basic goods and services such as food, shelter, and fuel, for which lower income groups must spend a larger part of their income. Okay? The main measure of how badly inflation affects people is the amount of income it takes away from them. The amount of income it takes away from them. So we are talking about the poor feeling the pinch of inflation, because most part of the income of the poor is spent on basic goods, the basic commodities like food, shelter, and clothes. So find that an individual who earns, let's say 30,000, okay, per month. Assuming this individual has no family, which is rarely the case, okay? In our society, people have families. Those who don't have families have dependents. So let's, for the purposes of learning, assume that this individual does not have a family. So you may find that the individual spends, say, 5,000 on transport, shelter, say, 15,000. This is food. Food, give it 5,000. Shelter, 15,000. Clothes, say, if it is a man, give him 2,000. Okay, food. There's also transport of say 3,000. So you can see now this brings to a total of 25. Before including expenses like airtime, because remember airtime was included in the basket for computation of the consumer price index. Airtime 2,000 per month, that is equal to 27,000. These are basic needs. You can see when we say the poor feel the effect of employment more than the rich, and the reason is that this inflation, remember inflation rate is inclusive. That increment is in these prices. Okay, so the most of the income of the poor or the middle earners is spent on these basic goods. So you can see here the inflation rate, it eats more into the income of these poor or middle earners more than the rich. And you can see here that if you are to think of a rich person who earns, on the other hand, 300,000. Okay, 300,000. And you see, when you're talking about food, the price for food is the same whether is the poor buying or the rich. Okay, so you see some of these expenses may be they are constant. When you are talking about the poor still, the rich man or the rich woman will still buy the flour at the same price. They are buying the same goods. But you see now, after buying all this, the percentage of income that the poor has after paying these basic goods, in this case you can see this is just 3,000. And you can check the percentage that the remaining percentage in case of the poor person. So the reason why, and this is why we say that there is a notion that the poor are getting poorer and the rich are getting richer. And that is a reason why it has been said that the richer are getting richer and the poor get poor. And we have said that the effect of inflation may be felt more by the lower income groups because it has a greater effect on basic goods and services such as food, shelter, for which lower groups must spend a larger part of their income. The poor spend a large part of their income on buying goods, basic goods and services that are high as a result of inflation. Because you can see out of 30,000, this poor man spends the 27,000 just on goods that are basic. Okay, but you see that is an impact, general impact, but you want to go deeper and discuss various effects of inflation of the economy, various areas of the economy. And one is the money value. Number 2, incomes. Number 3, inflation has impact on savings, on debts and other assets. It also has an impact on income distribution, interest rates, output and employment, resource allocation, economic growth, and trade. Economic growth and trade. So we will discuss firstly, the money value, or what you may call value of money. When prices go up, the real value of money is reduced. A given amount of money will therefore buy less goods and services. The real value of money is given by the value of goods and services that the consumer will actually buy with that given amount. Inflation will affect or undermine the ability of money to carry out its functions in an economy. If the value of money, for example, fluctuates considerably because of changing prices, people may not accept the currency as a medium of exchange. This is because people will not want to hold money which becomes relatively worthless quickly. Similarly, if the value of money falls, the value of goods, services, sales agreements, receipts and payments that are fixed in money terms will also fall due to the reduced purchasing power of money. Therefore, as prices rise continuously to high levels, money loses its value drastically to the extent that people lose confidence in the currency. And at this point, the currency becomes worthless and no one wants to hold it. The rapidly rising prices, therefore, undermine the role of money as a store of value so that people want to spend it as quickly as possible. Okay? So if you have money today and that money will lose value tomorrow, you would want to spend that money today so that you are not at a loss. Because remember, if the price of sugar, say, is 100 shillings per kilogram, 100 shillings per kilogram today, per kg, assuming the inflation rate is 50%, okay, 50%. This is, say, inflation rate of 50%. This is a runaway inflation or galloping. So if this is the inflation rate and monthly inflation rate, for example, then it means that after a month, then this sugar will cost, say, it will cost 100 shillings times 1.5, which is equal to 150 shillings. Okay, the same money that you used to buy sugar yesterday at 100 shillings per kilogram, you cannot use the same amount of money to buy the same kilogram after a month. So how will you behave? You would want to spend this money today as fast as you can and buy, say, 1 sack of sugar. You buy 1 sack of sugar in advance. So you would want to do away with the money because that money is losing value. That's what we are calling value of money is eroded by inflation. The power of that money, the purchasing power reduces with time at the rate of inflation. So that is an effect of inflation on value of money. Okay, so individuals would not want to hold that money for long because it is eroding. The quality, or I mean the value of money goes down. Then number 2 is incomes. What is the effect of inflation on income? The effect of inflation on households' incomes is seen in terms of how the purchasing power of the households will be affected. If incomes and prices increase at the same rate, then the purchasing power or ability to buy in goods will remain the same. In this case, households will not feel the effect of inflation because their real money is not affected. Real income is the value of goods and services that the consumer would actually buy with the amount of income he or she gets. If, on the other hand, prices rise while incomes remain the same, or prices rise faster than incomes are rising, then the purchasing power of the households will be reduced to the reduced value of money. It means that the same amount of income will buy fewer goods and services as prices go up. Okay, as prices go up. So there are two things here. We are talking about effect of inflation on incomes. Okay, and we're talking about real money being the amount of goods and services that consumers or an income earner will buy using his income. So if inflation rate is increasing at the same rate with the income, that means if inflation rate increases, say, at 50%, that is inflation, and income also increases at the rate of 50%, then this inflation will not have an impact on the income or the real income. Okay, the real income, because the same goods that this earner buys with his income, when the inflation rate is at 50, the same amount of income will still buy the goods because the income is increasing at the same rate. And you can even use this example. An income earner buying sugar at 50%, at 50 shillings, 100 shillings, and the income at the rate of 50% buying sugar per kilogram. If there is if inflation increase of 50% and his income also increases by 50%, then he'll afford to buy this sugar without any complaint. Okay, because his income has increased to take care of the increase in the inflation. But where inflation rate increases at a higher rate than the income, then that is a problem. Then that's a problem, because the same amount that this consumer used to buy goods using his income, he cannot use the same amount to buy after inflation, because his income is constant. Okay, the real income is constant. So that is an effect of inflation on income. So the third effect is income and wealth distribution. Income and wealth distribution. We have seen that to maintain a given expenditure pattern over time, the incomes of households need to increase in the same proportion as the increase in prices of goods and services. If the incomes of the households increase at the same rate as the income in prices, inflation will not cause any changes in income distribution. That is what we have discussed in point 2. This is because both incomes and prices are changing in equal proportion. If both prices and incomes doubled, for example, each household would get twice the amount of income before, but it will also have to deal with prices that are twice as high as before. Each household's real income therefore remains unchanged. The households would still buy the same amount of goods and services as before. If income is not increasing, at the same rate as inflation, then the household's real income goes down. It goes down. It reduces. It is eroded. And the households will not be able to afford the same goods and services as before. Okay? So inflation affects distribution of income only to the degree that it alters the way the flow of total income is distributed by income class. That is lower, middle, and upper income classes. Inflation can also alter the distribution of income by causing changes in the distribution of net worth of households. Hence, inflation can simultaneously alter the distribution of both net worth and income flows. However, how the net worth or wealth position of households are affected by inflation depends on how inflation affects money value of particular assets owned by each household and the money value of the debts owned by each household. So the debts are normally fixed in terms of money terms, okay? That is, they are fixed claim debts and hence do not become larger or smaller in money terms as prices rise or fall. As prices rise or fall. So that is how inflation affects wealth distribution. Wealth distribution. Then savings. Savings are the monies people set aside for future use. Savings are normally valued in monetary terms because money serves as a uniform unit of account, thus providing a common basis of comparison for the value of goods and services. Therefore, money enables the holder to convert goods and services into store-up purchasing power for the future. Savings are usually held in form of cash, bank deposits, insurance policies, or government bonds. If money loses its value due to inflation, its purchasing power is reduced, thereby reducing the value of the savings. Reducing the value of the savings. The reduction in the value of the savings will discourage people from saving as they feel they would rather use their money as soon as possible. People may also prefer to invest their money in assets such as houses, land, and other fixed properties because inflation usually has less effect on such permanent assets. So that is the impact of savings. Impact of inflation on savings. Normally savings are made in monetary terms. Money, cash. You save cash in or bank deposits. Okay? You save your money in a savings account. And where there is high inflation, individuals would not want to save. Okay? Because when you are saving, you are storing money in cash. Okay? But if we have seen cash can lose value because of inflation, then individuals would want to have their savings in other assets like land. You'd rather buy land because land sometimes is not affected. It's not affected by inflation, permanent assets. Or you can even buy animals. You can buy an animal like a cow instead of having cash during times of high inflation. So it has an impact on saving. So people would, other than saving, people would choose to convert their cash into permanent assets. So inflation can cause the power of savings to reduce, and thereby causing individuals to think of other ways of storing their wealth other than in cash form. Then debts and other assets. Debts and other assets. Debts and other assets. A debt is an amount of money owed to another party and needs to be repaid. Generally, debts owed are fixed in money terms, and a sharp rise in prices will therefore reduce the value of debts by the same proportion. When prices double, the real value of debts will be reduced by half, so that the amount repaid is equivalent to only half of the amount originally borrowed. Similarly, the value of other assets such as mortgages, bonds, and contracts, for example, for wages, salaries, and insurance, will fall as prices rise. This reduces the purchasing power of the households. So inflation reduces the value of all debts, savings, and other assets whose values are fixed in money terms by reducing the purchasing power of money. Hence, a person who borrows money gains from inflation because the sacrifice, when valued in terms of goods and services, in repaying the debt is reduced. On the other hand, the person who has lent out money loses because the real value of money repaid is less than the value of money originally lent out. All right? So, the debt, we are talking about debts. 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 If I was to lend you, I'm talking about you. If I was to lend you, say, 50,000, January 1, 2017, I've lent you 50,000. Okay? Or I've sold goods to you, but you've not paid me. All right? That means that you are my debtor. Okay? You are my debtor. You have a debt to pay in future. You have a debt to pay in future. And the debt was on January 2017. I've given you goods valued at 50,000. That means you have fixed that amount today. So that if you are to pay me in March, that is after 3 months, March 2017, you are supposed to pay me the 50,000. All right? I lent you 50,000 on January 1. You owe me the 50,000, which you ought to pay after 3 months. The same amount. That's why we are talking about being fixed now. The debt is fixed. So when you pay me 50,000, I will have lost because we did not factor in the inflation rate. If this debt increases if it doubles because of the inflation rate, okay? They're talking about the value of money. Because this is 50 and you're going to pay 50. But you see, because of inflation, if there is a double, then it means that you ought to have paid me 100,000 because of the inflation rate, the effect of inflation on this. Because the value of money, you have just mentioned there that money loses value with time as a result of inflation. If because of inflation, this debt has increased to 100,000 and you are still going to pay me 50,000, you see I would have lost. And you, because if I'm your debtor, then it means I am your creditor. I am your debtor, but from your books, from your side, you owe me money. Then I'm your creditor. So it means you have gained here. Okay? You would have gained because the goods that valued 50,000 in January, okay, at the end of March, because of inflation, these goods are to be sold at 100,000 shillings. Assuming I had not sold to you in January, then it means I would have sold the same goods in March at 100,000. You see, now I have lost because of just time. That's why we are calling it time value of money. Money loses value with time. So after 3 months, you see, the same 50,000 in January does not have the same purchasing power in March. So I would have lost as a debtor, but you will have gained as a creditor. So that is an effect. We're talking about effect of inflation on debts. And that is very clear enough, okay? That is clear enough. So next time I lend you money, I will not fix it at that. We'll go and check what is the inflation rate. So I tell you now, you want me to sell to you this goods at 50,000. But are you aware that the inflation rate is at double digit? If it's double digit, then we need to apply the inflation rate, so we adjust the 50,000 to 100,000 shillings because you are paying in future. The value of money in January 1 does not have the same purchasing power 30th March 2017. So that is the effect of inflation on debts. Then you can also discuss the effect of inflation on interest rates. Interest rates. The rate of interest is the cost of credit in the economy. The cost of credit. That means if you are to take credit, then you need to pay. It is the cost of credit. Interest is the cost of credit. Cost of credit. If you take credit from a bank or loan, then you need to pay because the bank is giving you money so that you can use that money to do business. You are supposed to return that money with some interest. That interest is a cost to the one who is borrowing. Okay? So interest is a cost of credit in the economy. When there is an oversupply of credit, that is a high supply of loanable funds by financial institutions, the rate of interest falls. When there is a lot of money in the economy, banks are looking for people to give money. Then because of the law of supply and demand, then the rate of interest falls. When the supply of credit reduces, the interest goes up. When there is little money in the economy, then getting money, you need to pay very high interest. The supply of credit depends on the money supply in the economy. You need to understand that first. Okay? And it's easy for you because you understand the laws. All right? We have seen that excess demand in an economy causes the price level to rise. That we saw. Another point is in regard to output. Output. How does inflation affect output? As people work hard in order to maintain their standards of living, they had before inflation set in, they produce more goods and services. During times of inflation, people work very hard because they need to meet or to maintain their standard of living. In the process of working very hard, more goods are produced, more services are produced. So that is a positive effect on output. Then another impact is on resource allocation. Resource allocation. During inflationary times, people tend to use the available resources in the most economical way in order to avoid wastage. I give a simple example of cost of fuel. One may opt to prepare a meal that would be eaten twice instead of preparing 2 meals. Okay, instead of preparing 2 meals, those individuals may prepare meals for several days, and in the process, cost of fuel is saved. That is a simple example of a household. The same can be applied in companies, where companies may come up with means or ways in which to cut down on costs. So those are some of the effects of inflation. Okay? Effects of inflation. So, and I know when asked, maybe in an exam, what are the positive effects of inflation? You should be able to give positive effects. You may also be asked, what are the negative effects of inflation? Because inflation can also have a negative effects. It can also have positive effects. Okay, because it depends on how you argue your point. Like in summary, I can give you some summary of maybe how you can argue your case when asked about the positive impact of inflation on an economy. Positive effects. I even gave you one when I talked about debtors may pay less. Remember, we say that inflation may benefit debtors in that they end up paying less in real terms. That is a positive effect. That is if you are looking things from the point of view of a debtor. That example I gave on board. Then, just in summary again, we can say sellers may earn more. All right? Sellers may benefit from inflation in that they buy goods when prices are low and sell them later when prices are high, thereby making profits because of the time lag. So sellers may earn more. So that is a positive effect when you look at it from the perspective of sellers. Then you can also argue motivation to work. Inflation may have some motivating effect to work as people try to cope with the effects of inflation by working harder. As prices of commodities go up, people may find that they are not able to buy the amount of a commodity they were buying before the inflation set in. In an effort to maintain their standard of living, they may work harder in order to earn more. Okay? In Nairobi, they call it side hustle. If you are employed somewhere, then you have what we call a side hustle, so that you can have ends meeting. People work harder so that you can be able to buy the same goods that you used to buy before inflation set in. So it is a motivation. It has a motivational impact or effect on people. Because remember, we said that if you are in the middle class or lower class, most part of your income is spent on basic goods that are subject to high inflation. So, and the basic goods, we are talking about goods that must be met. You have no option. You have to eat, all right? You have to get food. So when you cannot afford food before inflation sets in, after inflation sets in, you are not able to buy goods. Then you need to work harder because you have no option. You have no option. If you're in town, then you either work hard or go back to the village. Because in town, you need to meet some certain expenses like house. House is basic. You must pay rent. You must meet the landlord at the end of the month. So you have no option. So you're saying that can motivate you. Because the landlord can just say it's increasing rent because of the increase in the rate of inflation. Because remember, consumers are the ones who bear the burden of inflation at the end of the day, because inflation is factored in prices of commodities. So if you want to avoid inflation, then one way is not to buy the goods or services. For example, in case of rent, if you don't want to pay the rent, the inflation that is fixed in rent, then one way is not to pay rent. And you are aware shelter is a basic need. So inflation makes people work hard. It also makes people think on how to survive, and somehow people make it, including, you saw when we said in Zimbabwe, the inflation rate rose to mark 1 trillion% inflation rate. That is hyperinflation, but people are still somehow managing over there. Okay, so because you see, people have to live because of this basic. So motivation. Remember, I'm just helping you how you can argue when confronted with a question on, for example, explain positive effects of inflation. So I've talked about debtors may pay less, sellers may earn more, motivation to work. Then there is increased production. Increased production, we discussed that one here. Then there is better use of available resources. That is a positive effect. Then you can also argue the negative effects of inflation. That is reducing or reduction in profits. Inflation can lead to reduction in profits. And how is that? Because rise in prices of commodities may lead to reduced sales volume for farms, as many customers may not afford the high prices. This in turn may reduce the farm's profits. Okay? That is self-explanatory. People may not buy certain goods, or they'll cut down on expenditure. If they've been used to having 3 meals a day, you are the shopkeeper who supplies foodstuffs to a household, 3 meals a day. Due to inflation, this household may not be able to afford the 3 meals, so they may resort to having 1 meal, just 1 meal, call it supper. Okay, so that will, this shopkeeper's revenue will go down, the volume of sales will reduce, and with the reduction of sales, then profits will also reduce. So that is a negative effect. Then there is also wastage of time. Inflation can be wasteful. It can be wasteful in that individuals and firms may waste a lot of time shopping around for reasonable prices. Shopping around for reasonable prices. I remember sometime in my village, when you increase price by 1 bob, someone would walk for 10 kilometers looking for cheaper shop so that you can save the bob. Okay? Can save. So people may waste time looking for, hopping from a shop to the other, looking for cheap products. Okay? Because people are now cost conscious, right? And you can sometimes, in your observation, some of them, you find them in the supermarket. Someone is using calculator to see how much you can spend, which is a good thing also. So you can know, you plan your budget very well. So and that's a negative impact. You can lose a lot of time looking for cheaper commodities. And you know, time is a resource. Time is a resource that may be wasted on looking for cheaper goods or bargaining. There are those who may spend many hours bargaining so that they can save, and that can waste the buyer's time and the seller's time. So that may lead to wastage. Then there is also conflicts between employers and employees. During inflation, firms are usually pressurized by employees and trade unions to raise employees' wages and salaries to cope with inflation. A conflict may arise between the parties concerned regarding the level of increase that is adequate. And that's why in developing countries, there are many instances of strikes. Striking. You may find that doctors have gone on strike, nurses have gone on strike, teachers are on strike, members of parliament are on strike. Everyone is striking because of the level of high rate of inflation. So it brings conflict between the employers and employees, and that is a negative effect. When there is conflict, then you see the environment for work may also not be conducive. Okay? People come to work, but they are not thinking of production because they have real needs. They cannot meet needs because you cannot be comfortably working when you know the landlord has locked your house. So that's why you may see some employees are not comfortable working. The production has gone down. So that's why we are saying inflation can affect now even production. As a result of the conflict, then there are even other effects which you can also argue. And you can see now in such a case, inflation has an indirect impact, okay? The conflict is direct, but that conflict again has other effects which may have a bearing on production, negative bearing on production. Then there is another point you can argue, which is decline in standards of living. Decline in standards of living. Inflation can lead to decline in standards of living because during inflation, consumers' purchasing power decrease. This is so especially for people who earn fixed income, such as pensioners. The reduction in purchasing power brings about a decrease in standards of living. Decrease in standards of living. I've mentioned here a household that used to take 3 meals. Now the household is taking 1 meal. You see the standard is going down. There are those even move houses. You had maybe rented a house, 50,000 shillings per month, a good house. Everyone in the house has his own bedroom. So because you want to cut down on costs, you shift to a one-roomed mansion, okay, or house. A house that there is only 1 room and it's a family. So you see now the standards of living going down because people are now looking at ways to save, ways to save. The standards of living goes down, okay? The cost of living, the standards of living is going down because the cost of living has gone up, okay? If you cannot meet the cost of living, then your standards goes down. You look for cheaper ways of surviving, cheaper ways of surviving, okay? If you are taking matatu or taxi home, now you walk, and that one is and in walking you see you are wasting time. You waste a lot of time, and that is what we are talking about, the negative effect, decline in standards of living. Then you can also talk about loss to creditors. Loss to creditors. Loss to creditors lend out when the value of money is high. At a time of payment, the creditors receive less in real money terms since the money value has been eroded by inflation. Remember the 50,000 I lent you, okay? You are to pay me 100,000 because that is now the real value of that money, but you're still paying me 50. See, as a creditor, I have lost. That is a negative effect from the perspective of the creditor. But you see, at the same time, you see you as a debtor, you gained. So when arguing these points, you see how the same point is it brings negative effect and positive effect. How inflation in such a case has a negative impact on the debtor, at the same time positive effect on the creditor. So that is loss to creditors. Another negative effect is retardation of economic growth. Retardation of economic growth. Inflation may create a situation where investors are not willing to either take risks, invest in new ventures, expand production, or hire more workers. This would bring about retardation in economic growth. During inflation, even now the producers, the employers would also want to cut down on costs. And one way in cutting down on costs is laying off workers. Workers are laid off so that the employer cannot pay salaries. When you lay off your workers, it means now there is little production. You are cutting down on production. When you cut down on production, it means on aggregate, the impact, the final impact on economy can be felt because production has gone down. Production has gone down. That is a negative impact. There is a retardation on economic growth. I've just given an example of labor or salaries. Employers can also cut down on operations. We've seen companies closing branches because of they cite inflation as one of the causes, the consistent increase in cost of doing business. Okay, the companies are not able to cope with the rate, so they just either close shop or cut down on production. So those are some of the disadvantages. I remember we also talked about savings. Inflation may lead to people being discouraged in savings. During inflation, people tend to spend most of their earnings leaving little or nothing to save. Okay? That is a negative impact. Because you may want to save, but you have nothing to save. So that is, it may discourage savings. Then lastly, we can talk about loss of confidence in the monetary system. High levels of inflation may lead to loss of confidence in money, both as a medium of exchange and as a store of value. And this may lead to the collapse of the monetary system. People will not want to hold that money because the money is eroding in value. So people will not want that money as a medium of exchange. They may also not want it as a store of value. You do not want to store your money, your wealth in monetary terms, because those are some of the functions of money. Money is used as a medium of exchange and a store of value. Okay? When you sell your property, you may want to keep the sales, the proceeds in monetary terms. During inflation, that is not what you'd want to do, because that money, after some time, it will lose value at the rate of inflation. So those are some of the points you can argue. We've looked at today on the impact of inflation on the economy. And when discussing impact of inflation on the economy, these effects can be felt by households, can be felt by businesses, can be felt by the government. All right? So we stop there for today, and we'll look at more aspects of economics in our subsequent video lectures. Bye-bye.